Hi everyone, in this video we'll be starting with the chapter number 18 of CMT level 2, which is understanding implied volatility. Before watching this video, make sure that you've checked the previous videos of this level. The playlist link is given in the description box below. So in this chapter we'll be talking about what is implied volatility and how do you use it in your trading and what does the implied volatility signify. Implied volatility will also be referred as IV. So whenever I say IV, just know that I'm talking about the implied volatility. So we're going to talk about the contrast historical and implied volatility. Implied means what we think might happen, and we'll be seeing how we can use that in forecasting and in taking our trades. We're also going to see that how do one sec. Yeah. We're also going to see that how we are going to calculate one day IV, and we're going to see that how it's going to affect an option price and how we are going to use it in estimating the future price of a particular stock. So we'll be talking about the ins and outs of a popular market indicator or the index, which is known as implied volatility. So the indicator is CBOE volatility index, which is known as VIX. In India, we have the India VIX, which is a whole index or a chart in itself. Similarly, they are talking about CBOE volatility index. Okay, so first let's talk about what exactly is IV. IV is ultimately determined by the price of options contracts. Since option prices are the result of market forces are supply and demand or increased levels of buying and selling. The what determines the price of an option or a stock or anything in general, it's always the market forces always determine the price of option contracts, right? And the market forces are basically the demand and supply, which is also known as the buying pressure and the selling pressure. So there's an index which is based on IV of option prices displaying in the market's estimation of volatility of underlying security in the future. So IV basically talks about what kind of volatility um, can the particular asset or the underlying show in the future. So let's talk about the historical IV and the forward-looking IV. So there are two types of volatility which we can discuss with relative to securities prices. The first one is the historical volatility, which means something that has already happened in the past. This can be calculated using the recent trading activity for a stock or security. The historical volatility of a stock is factual and it is known. Since it has already happened and since we already know what has happened, it is very easy for us to calculate it. But when you have to look at the forward looking IV, it is more difficult to calculate. Historical volatility does not give any indication of what the future will happen, what the future will be like. The forward-looking volatility is what is referred to as the implied volatility. So the main thing which we are going to study in this topic is not the historical volatility but about the future volatility, which is also known as the implied volatility. This type of volatility results from the market price of options that trade on a stock. So market price is what we are going to see. Okay. The IV component of option prices is the factor that can give all option traders, novice to expert, the most difficulty. This occurs because the IV of an option may change while all other pricing factors impacting the price remain unchanged. Like we have seen in the options lesson that a lot of factors influence the option price. Out of all of them, rest can be fixed, but IV is something which can be unchanged and which can always keep changing and adjusting itself according to the volatility which is present in the market. This change may occur as the order flow for options is biased more to buying or selling. A result of increased buying of options by market participants is higher implied volatility. When there is net selling of options, the implied volatility indicated moves lower. So if there is more buying in the option, again, pay attention to what I'm saying. I'm not saying that the buying in the stock, I'm talking about the buying of the option, whether it is a call option or a put option. If the buying increases, that means that the IV is increasing. And if the selling is increasing, then the IV is decreasing. Basically, the nature of order flow dictates the direction of the IV. Again, More option buying increases the option price, and the result is higher IV. As the option price increases, the IV also increases. Implied volatility reacts to the supply and demand of the marketplace. Buying pushes the IV higher and selling pushes the IV lower. The IV of an option, just a second. The IV of an, where were we? Just a second. Okay. The IV of an option is also considered an indication of the risk associated with the underlying security. By calculating the IV, you can know how much risk is there. The risk may be thought of how much movement may be expected from the underlying stock over the life of an option. We can expect whether it will move 10 points, whether it will move 100 points. That is what they're talking about. This is not potentially in the direction of the stock price move. This is the magnitude of the move. So we are actually just referring to the volatility or the magnitude of what the move could be. We are not talking about the price of the underlying itself. Traders think of a stock losing its value or the price moving lower. That's what we think of when we talk about risk. But we are not talking about that. Using IV as a risk measure results in an estimation of the price move in either direction. Whether the price goes up or down, we are just talking about how much magnitude of move can occur. When the market anticipates that a stock may move dramatically, the price of option contracts will move higher, both. Let's say there's an earnings which is going to come tomorrow. In that case, what happens? The IV of the call as well as put, both is going to be spiked up. So the option price of the call and put both are going to be high, because everyone knows that tomorrow the result is going to be announced and it's either going to be very good or it is going to be very bad. So either the calls are going to double, triple, or the puts are going to double, triple. So in cases like that, we can say that a high magnitude of movement is expected. When the market anticipates that the stock may soon move dramatically, the price of the option contracts will move higher. A common example of a known event is the company's quarterly earnings. That's what I told you. So that's what we just discussed. So I'll not read that. This increased buying of options results in higher option prices. There are two ways to think about this. The higher price of the option contracts results in higher IV, or because of the higher IV, the option prices are higher. Both can be taken into account. After the earning report, there is a less risk of a big move in the underlying stock and the options become less expensive. Why does that drop in the price happen? If Reliance is giving its quarterly earnings tomorrow, then today the option prices are going to be very heavy. But tomorrow, once the earnings are released, once the report is released and published, then the option contracts become cheaper. That happens because of IV, because IV is no longer spiked up. Because there is a less risk of there's a less risk of a big move. The big move has already happened, so we don't think that a big move will happen again. So that is why IV is now lower due to the lower option prices. A good non-option oriented example of how IV works may be summed up through this illustration. If you live in Florida, you are familiar with the hurricane season. The path of hurricanes can be unpredictable, and at times homeowners have little time to prepare for the storm. Using homeowners insurance as a substitute of an option contract, consider the following situation. You wake up to find out that an evacuation is planned. You wake up to find out that an evacuation is planned due to a potential hurricane. Before leaving the area, you check whether your homeowner's insurance is current. You find you have allowed your coverage to lapse, so you run down to your agent's office. As he boards up windows and prepares to evacuate inland, he informs you that you may renew, but at the cost is going to be 50,000 instead of 2,000 annual rate you have paid for years. After hearing your objections, he is steadfast. The higher price, he explains, is due to the higher risk associated with the coming storm. Do you understand the example that is explained over here? So initially, you just have to pay 2,000 as a premium to the insurance company, right? Because no big move is expected. But if you're going to the station, right, insurance place right now, right before the storm is going to happen, that means that there is a 99% chance that the storm is actually going to occur, and there's a 99% chance that the company will have to give you insurance for the same. So which is why the person is not charging 2,000 anymore, and now he's charging for 5,000 from you, because now the unforeseen event is actually happening. And That's why the option contracts are also spiked out during the big events, because they know that now more and more people will buy because such a big event is going to take place. So this is a very good example which they've discussed over here, which relates to how option contracts really work and why the option contracts are um, sold for a very high rate when there is a news or when there is a big report or a big uh, declaration which is made by the company. You decide that 50,000 is so okay, not 5,000. They were talking about 50,000, by the way. Imagine it's that much of a difference. You decide that 50,000 is too much to pay and you return to home to ride out the storm. Fortunately, the storm takes a left turn and misses your neighborhood altogether. Realizing that you have experienced a near miss, you run down to your agent's office with a 50,000 check in hand. Being an honest guy, he tells you the rate is back to 2,000. Why? Because now he knows that this situation might not happen again. Got it? The the imminent risk level for replacing your home has decreased as there is no threat anymore. As the immediate risk of loss or damage has decreased tremendously, so has the cost of the protection against the loss. When applying this to the options market, risk is actually risk of the movement of the underlying security. Either it is higher or it is on the lower note. The risk is the magnitude of expected movement of the underlying security over the life of an option. When market participants are expecting a big price move to the upside in the underlying security, there will be net buying of the call options because you think that a big move is going to happen towards the upside. As this buying occurs, the price of the call options will increase. This price rise in the options is associated with an increased risk of a large price move. And this increase in risk translates to higher IV. Hope you got it. Now let's take another case where there's an expectation of a lower price move. In that case, people will, start buying puts. With higher demand for put contracts, the price of puts may increase, resulting in higher IV for the put options. So finally, if put prices increase, the result is corresponding call prices rising due to a concept which is known as put call parity. Let's talk about that in the section here. Okay. Now, put call parity is something which is very, very frequently talked about in the option space. Now, let's try to break that down. Put and call prices are obviously linked to each other because both of them are linked to the price of the underlying stock or instrument. So that is what is known as the put call parity. That is for me. That means that a put and call have to be in some sort of an I wouldn't say equilibrium, but they have to be related and linked to each other because end of the day they both are corresponding to the same underlying. This link exists because combining a stock and put option can result in the same payoff position in a call option with the same strike price as put. If this relationship gets out of line or not in parity, an arbitrage opportunity exists. When one of these opportunities arises, there are trading firms that will quickly buy and sell these securities to take the advantage of the mispricing. Arbitrage is basically taking the advantage of the mispricing of the option contracts and the underlying security. Okay, let's look at this table over here. They have given an XYZ stock. The price of the stock is $50. The price of the call option of 50 strike price is $1 and the 50 put option is $2. Now, put and calls should remain within a certain price range of each other, right? We just discussed that. Why should it be in a particular range? Because if not, then the people will come and take the advantage of the mispricing, which they are known as the arbitrageurs. So parity between two also results in a similar implied volatility output, resulting from using these prices in a model to determine the IV of the market. Increased demand for a call option will raise the price of the call. As the price of the call moves higher, then the corresponding put price should also rise, or else there will be an arbitrage trades. So they have both the call and the put have to usually be in a same particular range. As the pricing of the option contracts are tied to each other, they will share similar IV levels as well. So that is why, like I told you, that when there is an earnings report which is going to come, then there is an IV spike in both the call as well as the put option. Okay. Table 18.1. Okay. All right. So the XYZ stock, which they have explained, given the example. Let's just see what they have to say about it. Using the XYZ 50 put combined with the XYZ stock, a payout that replicates being long the XYZ call may be created. Let's say a person has taken a call. The combination of owning the stock and owning the put has the same payout structure as a long call option. So if I have a put with me and the stock with me, then it has the same payoff, right? Because of probabilities. Now let's say if it's the call option trading at 1 and the put option priced at 2, there may be a mispricing scenario. Okay, this is the table over here. Now let look at the payout comparison which is given over here. First of all, at the expiry date, let's see that the stock is at 45 now, which means that the stock is now expiring at a lower price. In that case, if you were long at a stock, if you bought the stock, if you purchased the stock at 50, by the time of the expiry, your stock is at 45, which means you will have a minus $5 loss, right? And the put which you purchased it at 2, right? Now the put will have increased its value, so you made a $1 profit. Clear? Now let's see, we have a long stock and a long put. That's what this case is, that you have a stock also with you which gave you a loss, but the put gave you a profit. In that case, you're making a profit of $1. In the second case, let's say by the time of the expiry also, the price of the stock is at 50 only. Then what will happen? The price is still 50, so the stock which you had purchased is giving you zero profit or zero loss. It is right where it was. The put option which you bought, that's going to become zero now, so it's giving you a loss of -2. Now, in this scenario, if the price remains the same, you are going to have a loss of $1. Now, let's see that the price increased and the price of the stock is 55 at expiry. Then the stock which you had purchased is giving you $5 profit. The put which you have purchased is giving you a -2 because the put option is worthless now because the price has increased. Then you make a profit of 4. Do you get that? Are you able to understand what I'm trying to say? Think about it. Just pause and just see this. Again, one thing, let me just explain this column properly because I've just been explaining this total to you. I'll also explain this quickly. Okay. So you remember that we discussed that the call option is 1 rupee, $1. So if the price is 45 now, then what will you do? What will happen to call? And if the price is 50, then what will happen? Nothing happen. You lose it. If the price is 55, you gain the money, which is 4. So this is how you are going to use, and what people do, especially people who are in the hedge funds, they hedge the stock, and if they think that the stock is giving them a negative this month but overall it's still bullish, so they don't want to sell it off. For the time being, they will buy a put option in order to hedge their positions. Here it should be -1, by the way. I think it's a mistake. Okay, so that is the payout graph. Look at this. This is the payout diagram comparison which we just discussed. Okay. Due to the put call parity and the mispricing between the 50 call and 50 put, the call may be purchased combined with a short position in the stock and put option. Exactly. So that's what they're saying. What is a put call parity? You can buy a stock with the stock. You can buy a stock and the stock option together. So in that case, what happens is you are getting an opportunity to make more prices because there is a mispricing in the price because the call and the put option, both of them have to be priced in the same range. So you'll get a profit. Okay, now let's go to the next topic. Estimating price movements. So what the implied volatility of an option projects onto the underlying security is the expected range of the price movement over a certain period of time. that this much range of price movement is expected to happen in the given time, whatever the period of time is. The estimation of price movement is based on statistics and the bell curve. The IV of an option is projection of an annualized one standard deviation move in the underlying stock over the life of an option. One standard deviation move. According to statistics and using IV as a guide, the price of a stock should land between up and down one standard deviation at option expiration. The closing price should land in this range 68.2% of the time. So most of the time this is what happened, that one standard deviation of the option price up and down, only this much it can move. It cannot move more than the 1% standard deviation of time, and this is what happens most of the time, which is a 68.2% of the time. So the 68.2% comes from statistics and it is referred to what is known as the normal distribution. So whenever we are talking about normal distribution, we are talking about the 68.2% of the time. So a stock should move between one standard deviation up and down from a year from today. A formula may also be used to take this annualized number and narrow down the projection to a single day. The normal distribution also indicates that there is a 95.4% expectation of the stock landing up to two standard deviations and reaches down two standard deviations. So the probability of that would be 99.7. With the stock trading at $50 and the underlying option price indicating 20% IV, the result is a one standard deviation price, which would be 20% of the $50. Now let's talk about what are the pricing calculators and other tools which we can use to value the options. So that is basically talking about the valuation of options. An options pricing calculator is a tool that allows a user the ability to input the pricing variables that determine the value of an option, with the result being a theoretical option price. Ultimately, the market determines the price of an option through buying and selling forces. However, when analyzing and investigating option trades using an option pricing calculator with certain assumptions, gives an idea where an option may be trading in the future. So there are various calculators which we can use. So you can check out this website if you want to know more about this particular option tool, which is used in the CBOE market. The value of an option contract is derived from a variety of inputs. Inputs into an option pricing model include the price of the underlying security, the strike price, the type of the option, the interest rates, dividends, time which is left for the option expiration, the expiration dates, and all these terms. The final input to an options pricing model is the IV of the option. These inputs may be used in a model to determine the value of an option. Let's look at the table 18.3. Okay. So we have call, put, underlying price, strike price, IV, days to expiration, interest rate, dividends, and then we have the result, which is an options value. Okay. Another method of demonstrating the impact of the IV is in table 18.5. Let's also look at the table 18.5. So you can look at this. Let's say the implied volatility is 30%. Then in that case, this would be the options price. You can just pause and look at it. We've just discussed this entire thing. Okay, let's just quickly recap what we learned. There is a direct link between the demand for the option contracts and their prices in the marketplace. This is regardless of changes occurring in the underlying stock price. With demand in the form of buying pressure pushing option prices higher, or an increasing in the selling occurring due to the market participants. Fluctuations which are based on supply and demand. So we saw that IV does not fluctuate based on the supply and demand. So what exactly causes the supply and demand for options to fluctuate? The short answer is the near term expected price changes that may occur in the underlying stock. These moves are usually the result of the information that has influenced the fundamental outlook of a stock. Again, the same thing which we discussed, that earnings reports can take into account. So that is what is explained over here. Okay. So a single day implied volatility can be interpreted as being a single standard deviation range of the expected price movement on that day. So how do you basically calculate a single day IV? So let's say there is 250 days trading day, 252 trading days in a year. We are saying that because there are a lot of weekends and there are a lot of government holidays on which the market is closed, then a 1 day movement would be equal to the implied volatility divided by the square root of 252. We are not taking 365 because if you actually look at every year, there are nearly 252 days of trading days. So when you divide the implied volatility by the 250 day square root, then you get the IV of 1 day or the 1 day movement. Now let's look at the impact on options prices. Implied volatility is commonly considered an indication as to whether an option is cheap or expensive. So this determination may be made through examining past implied volatility levels. Demand for options pushes up the price of an option contract and results in higher IV. However, other factors such as the underlying price, time to expiration, and all of these also determine the price of an option. Other factors are not impacted through the buying or selling pressures. Only the implied volatility will fluctuate based on market buying and selling pressures. Okay, so there's nothing. I read the last 3 pages because there's nothing much to explain since we've already discussed this. Okay, as a simple example, take the option prices and implied volatilities in table 18.8. The data in this table is a stock which is trading at 24 rupees and the value of the call option is 0.80 and it has 90 days to expiration. The different option prices are based on various IV levels. Note that the option price increases. Since the option price increases, the call option will also increase. If options for the underlying stock usually trade with an implied volatility of 25%, then when the option could be purchased for 0.80, it may be considered undervalued or inexpensive. At 0.80, the option had an IV level of 20%. So you can see when the price was 0.80 of the call options, the IV was just 20%. And when the price increased, the IV was even more, which means it's a bit expensive. And finally, when the price is 1.30, the IV is 30%, which means you can assume for it to be overvalued or expensive. Okay. Now let's see the VIX index. The VIX index is something which we will be seeing in detail in the next chapter. Whereas for now, I can just tell you that it is again a measure which is used as an implied volatility. It is a use, it is a measured, it's a tool which can be used to measure the implied volatility. So for in this case, we are going to see the VIX option, which is going to tell us the movement of the S&P 500. If we would have been talking about India VIX, then we will be talking about the Nifty 50. So similarly, S&P 500. The VIX index can be used to indicate what type of market movement option prices are projecting on the S&P 500 over the next 30 days or even a shorter time. Since the VIX is measuring implied volatility and since the IV is a measure of risk projected by option pricing, the VIX is considered a gauge of fear in the overall market. So if you see that the VIX index is rising substantially, then we can say that there is a lot of fear or panic in the market. Okay, so we'll see how to use VIX in the next chapter. So that's it for this chapter. In this chapter, you just needed to know what is the meaning of IV and what do you mean by expensive options, what do you mean by cheaper options, and when does an IV increase and when does it not, and what is a put call parity and the payoff system. So that's it for this chapter.